Hi there. Welcome to another edition of TokStocks. I'm your host, Keir Reynolds. And today I'm lucky enough to have Ghassan Halazon, founder and CEO of Emerge Commerce, trades on the TSX Venture Exchange with the ticker ECOM. Hey Ghassan, how you doing?
I'm doing just fine, thanks, Keir. Nice to hear from you. It's been a minute, but great to be here with you and your audience.
Yeah, it's probably been about 5 years, 4.5 years or something since we kind of last chatted. Been very impressed with what you've been doing in the last sort of year, really kind of turning this company around. Many other people in your position may have chosen sort of a different path. You chose to sort of put your shoulder behind it, grind it out, and get this thing going. So now with where the company is kind of at, I thought it was an ideal time to do a sort of a first look for my kind of audience. And I am a shareholder, so I'm completely biased in terms of this interview.
Yeah.
Of course, we're not, this interview is not, there's no compensation, there's nothing. I'm just doing it because I'm interested in the company and a shareholder. So maybe, so we can kind of kick things off. Maybe you could explain a bit about who you are, what your background is, what you've done before. You've got a very impressive background. And maybe for those in my audience that don't know who you are, you could talk about yourself a little bit.
I appreciate it. I can certainly do that, Keir. So as you mentioned, I'm the founder and CEO of Emerge Commerce. Really, for the past 15 years, all I've been doing is building, buying, selling, restructuring e-commerce brands for a living. Um, my original background was actually in investment banking. I spent a few years on Wall Street with Citigroup. I did my MBA at Georgetown early days. So a lot of capital markets, capital allocation, M&A influence poured into my e-commerce lens, if you will. Really sort of nothing that, through the past 15 years, there's nothing we haven't really seen. Like, we've made all sorts of mistakes. We've made, learned some really valuable lessons, and we're pouring it into the Emerge of today. Emerge is an acquirer and operator of niche e-commerce brands. Once upon a time, we were a broad-based, diversified portfolio of e-commerce brands. We picked up, our timing wasn't great in the early days. We picked up a lot of high-flying assets at the peak of the pandemic. Most of that came down, as everyone's aware and might recall. At the same time, there was a bunch of debt in these sort of roll-up driven businesses, including ours. Interest rates went through the roof suddenly at a historic clip. And that combination was extremely painful to go through. But the Emerge of today is a lean, mean fighting machine. We've managed to eliminate the vast majority of our net debt. Almost 80% of our net debt position has been eliminated through sale of non-core businesses and sort of refocusing and streamlining the portfolio around our grocery and golf verticals. That is where we are today. We are growing. We have almost 2 years of organic growth. We are profitable. We are cash flowing. We are disciplined with our approach now. We've reignited our M&A or our acquisition vehicle or approach, but we're doing so with again, great discipline with a focus on cash flow in year one.
Excellent. Well, thanks for giving us a good sort of rundown. Maybe to kind of, so we can sort of set the stage for kind of the next group of questions. Can you give us a little bit of an elevator pitch for somebody that hasn't heard of Emerge Commerce today? Like, what specifically is it?
Right. Emerge is a Canadian-based acquirer and operator of niche e-commerce brands. Today, we're specializing in the grocery and golf verticals. We essentially leverage our knowledge and expertise in e-commerce, in digital marketing, in merchandising, and we apply that knowledge to these two specific niches to help them grow. So on the grocery side, we own True Local, the market leader in premium meat and seafood subscription from local farmers. Obviously, a huge year for support Canadian and local
Yes.
as a theme. We're seeing great leverage there in that business, both growth and profitability. And the other side of the spectrum, we own a 3-brand, 400,000 member portfolio, both golf experiences and products, both online and offline, and we're leveraging synergies across the portfolio to drive those businesses. Last thing I'll say here is that we've chosen these niches very purposefully. We love the metrics on them, the community, the brands that we're sitting on, because that was one of our big learnings, is that in e-commerce, you want to build a real brand and a lasting community, not just acquire EBITDA. And that was a learning, and that's why we've doubled down where we have.
Excellent. Well, thanks for giving us a good sort of run through on that. I'm an avid, big fan of golf, play a lot of golf. So eager to learn a bit more about those sort of businesses and how maybe you can help my game. We've heard a lot about kind of like the synergy cross-selling, maybe how some of the businesses you had before had very distinct customers that didn't really cross over. Are some of your grocery customers also golf customers, or is it really more you're a golf customer on one of your golf businesses could be a golf customer on the other three?
Right. It's the latter, actually. So there's a little bit of crossover. We always joke that a lot of the wives do the groceries and a lot of the guys, end up doing the golf. And we always wonder how many of them are actually in the same household. We probably have a good idea, but we wouldn't disclose that. But no, more realistically, a lot of the synergy comes within a specific vertical. So within golf, I have a couple of great examples, actually, one from prior years and one currently live. The one from prior years is Just Golf Stuff, justgolfstuff.ca in Canada.com in the US. It's our Shopify-powered marketplace for golf products, apparel, equipment. And when we acquired this business about 5 years ago, it was a $500,000 sales business. Today, it's about 10x that with no additional capital or no additional staff. And the biggest reason we've been able to do this is our captive golf audience on the Underpar side. Underpar is an experiences platform for discounted tee times across North America. We have hundreds of golf courses. And the reality is, at the time, a few years back, when the pandemic happened, everyone and their mother was playing golf. And unfortunately, that was actually not a great thing for our business because golf courses didn't need us to bring people through the door. And so we had to react and we had to move quick. And what we realized was, well, if everyone was playing golf, why not sell more of our golf equipment and apparel and take that side of the business more seriously? And so leveraging that same audience, we were able to pour that into Just Golf Stuff and grow it 10x with no additional hires. That was sort of a nice little case study a while back. And it really opened our eyes into the more immediate or the more active case study today that I think investors have been awakened to, which is the Tee2Green acquisition we picked up in April. This is historically, first of all, it's a 38-year-old business. It's one of these boring offline cash flow style businesses, $1 million EBITDA, but not growing much at the time of acquisition, about 3 to 5% grower. And we didn't acquire it, frankly, expecting crazy growth. We were happy that it would be a nice addition to the portfolio and that we would leverage its cash flow to drive our bigger goals operationally and balance sheet wise. Lo and behold, what we were able to unlock in the first couple of quarters is, again, not only leveraging our audience into Tee2Green, which is mostly offline, roadshows, pop-up stores, retail stores of equipment and apparel from everyone's favorite brands, the TaylorMades, the Callaways, the Adidases, the Pumas. But so by driving our audience, but also leveraging our golf advertising playbook, let's say, right? The way we target folks online or lookalike audiences. If you like golf and you're a member of ours, can we find someone similar to your profile, age, income, and target them with that sort of thing? And what we were able to unlock was, in Q2, our first quarter, we drove almost 35% organic growth of this historically 3% grower. Wow. And made our capital back in 90 days, which was eye-opening to many. And then in Q3, we pretty much saw similar momentum. We were able to drive similar levels of organic growth. So this is very real. It's exciting. And obviously, we structured this deal quite favorably on top of it.
Why don't we talk about that? So how did you sort of structure it? How was the acquisition kind of done? if you don't mind
Yeah.
going through a bit of that.
Yeah, and a little bit of background there is that one thing literally led to another. So with just golf stuff, the success we saw in growing at 10x through the years with no capital, um, opened our eyes to one of our big vendors, which happened to be Tita Green. So Tita Green has been in the game for a very long time. They have access to all sorts of clearance items. They have all the big brand licenses and relationships. And so they were bringing us inventory on just golf stuff, and our businesses were growing together through the years. So at some point, the owner on the other side at Tita Green decided that they were looking to retire, sort of a classical no succession plan situation. They needed to move to Florida. There's sort of personal reasons. And they approached us really and said, look, we think you'd be a great custodian. Our teams work together, and we've seen how you do business. We like, the transparency and just the communication and support. We gave them support when they needed it and when he needed it personally. And we structured a deal where we acquired the business for about 2.2 times EBITDA, with about 1 times or so upfront, which we call it 1.1 million on closing, which we recouped in less than 90 days. And the remainder was about, I think it was 800K in deferred payments. Maybe it was 900 originally. So call that 2 million. And then another 200K or so in ECOM shares. At the time, we were trading at 4 or 5 cents. Yeah,
Nice.
we did the deal at 6.5 cents. So it was a premium at the time. Obviously, we're now sitting at 10 cents plus.
Excellent. So, and you kind of mentioned a key there is that based upon the upfront cash that you sort of outlaid in sort of cash flow back in the
Right.
first 90 days, you're able to do quite well on it. So, good deal.
Right.
Uh,
And I would say one more thing I forgot to add was the inventory was a meaningful component. It was actually larger than the purchase price. It was 2.4 million in inventory that
wow.
we acquired. We picked up. This is all, we audited it with MNP, and again, we're talking best in class brands, the Callaways, the Pumas, the Cobras, and essentially we own all of that inventory on day one, but we pay it over 8 years. And that's turned out to be a huge cash flow advantage for Emerge, especially in the earlier years. We actually pay less in earlier years. And so when you couple that with acquiring the business right in time for golf season, that resulted in, our first $1 million EBITDA quarter in Q2. And it resulted in all that cash flow generation. Our cash position has grown quarter over quarter and year over year for multiple quarters in a row now.
Well, that's a great segue for the next sort of couple of questions that I'm going to ask you. We're going to dig in. You recently had your Q3 financials come out. They look pretty good. Again, more sort of growth, more sustainable growth. If you compare sort of quarter over quarter, this Q3 over last Q3, some pretty impressive kind of growth. Maybe you could kind of add a bit of a high level. Would you mind walking us through a few of the headline numbers?
Yeah, at a high level, Q3 was a super positive quarter as we see it. We did about 7 million in revenue, compared to about 4.4 million. So that's 58% in growth. EBITDA or adjusted EBITDA was 260,000, about a 500,000 plus increase year over year. I think we were in the minus 250,000 zone prior year. Our cash position grew to 4.1 million, up from almost up by 2.5 million year over year, and up about 5 or 600K quarter over quarter. So we hit on all cylinders from that perspective. I think, if I were to drum it down a little bit, I think, adding the second quarter of Tita Green under Emerge with continued organic growth momentum. So, by the way, we grew both on the golf side and the grocery side organically. I shared during our earnings call that the way to think of our business going forward is, organically, we're growing about low double digits, high single digit, low double digit overall across both verticals collectively. And then we're layering on that high double digit, so call it 50, 60, 70%, as you've seen in Q2 and Q3, that is coming from from acquisitions, right? So that is our model. So if you think of big acquirers, the most aggressive and largest of which that we all know is Constellation Software.
Yeah.
These types of companies grow 2-3% organically, but they're growing 20, 30, 40% via acquisitions. And now we're not trying to buy 100 companies a year or anything like that. God forbid. Maybe that was the Emerge 1.0 world, but no, more seriously, like I think we like this idea of balancing solid, healthy organic growth, but not crazy, with profitability today, not one day. And that's a big distinction, right? So we have the choice. We could be growing True Local 20, 30, 40%. No problem. The metrics are there. We can go that way, but it'll sacrifice profitability and EBITDA today. And I think what we're really trying to do is improve our profit and our EBITDA relative to our debt so that we can access much cheaper, longer term financing and continue to grow cash flow. In the end, this is a cash flow driven company, and that is our number one priority.
I think year to date you've had about $2.5 million of cash flow, which is pretty impressive considering where you kind of came from. Certainly not producing any operational cash flow, in previous years with
Right.
with the businesses. So that's going to be something to be kind of proud of. Is that like a trend that we can sort of like count on, or is there quite a bit of seasonality still in the business with sort of like
Yes.
golf, or have we gone into sort of a hot season for people purchasing gifts and making some purchases ahead of next spring?
Yeah, no, so good, great question. So 2.5 million operating cash flow year to date. That was a phenomenal result. I think, as you could tell from Q3 versus Q2, there is some seasonality, right? Q2 at this point is our largest quarter of the year. And it's a mix of all of the golf seasons starting, Tee to Green's pop-up stores and road shows at their peak. Everyone's buying stuff for the season. And then at the same time, True Local has a pretty strong quarter there as well. Not its number one quarter, but it's pretty strong. So it makes for Q2 being a bit of an outlier, as you saw, and we achieved $1 million in EBITDA in a single quarter, which is phenomenal to see, and built up some cash. But I will say that Q3, which is ways away from Q3 last year, it's a 500K delta in EBITDA. It's 58% growth in revenue. I think certainly that while not as seasonally strong as Q2, is still a healthy quarter for golf. For most of it, is golf is strong through most of it. September is a bit lighter normally. Now Q4, Tee to Green is much weaker and quieter. You don't have the road shows and all of that side of things. But then you get the corporate orders, the gifting, and all of these other things. So I think Q4 directionally is probably more in line with a Q3 than a Q2. And then Q1 is also somewhat seasonal for Tee to Green before the big Q2 jump.
Sure.
And for golf in general, as the weather gets colder and you're done with the holidays. But then it's also solid for True Local because it's the new year, new you. And that's like the biggest time of the year, actually, for True Local. We joke that that's the Black Friday season for True Local kind of thing. So I think we're overall pretty balanced. I would say with the exception being Q2 is just this big drive, but the rest of the year, give or take, is directionally balanced.
Now, there's been a little bit of slippage in terms of gross margin. If you look historically, you're kind of around a 40% kind of gross
Yeah.
margin. You've dipped down recently into sort of mid 30s. I think there's been a little bit of reason around that related to inventory adjustments and stuff
Yeah.
like that. Could you sort of like walk us through what should we expect your gross margin to kind of look like uh,
Once
through
things level
this
out.
new sort of emerge 3.0?
Yeah, no, absolutely. And we have a target 40% margin. That hasn't changed. I think internally there's a bit of noise because of this fair value accounting, which, by the way, is a non cash item and does not ultimately impact our cash flow. And so, a lot of companies, I will say this, and maybe we're not the best at this, a lot of companies come up with creative ways to show it. They call it adjusted
Yeah.
gross profit and blah, blah, blah. And we just really haven't bothered. Like we just say, this is what it is. This is this non-cash piece that until we cycle through the old inventory, we'll be done with it. And the number we always show is how much is left, or at least the reverse, how much we've sold of the old stuff. And so it's between Q2 and Q3, we have about 75% of it has been sold, indicating like there's 25% left. Now, whether that gets fully knocked out in Q4, which is generally a quiet season for it, or Q4 and Q1, effectively, we're almost at the end of this zone. And you can expect T2 Green's margin. I know the overall company average or target is 40, but T2 Green itself is in the 40 zone. And I think once, for us internally, you don't see this breakdown, but once we adjust for fair value at T2 Green, it is at around 40% right now. So I think that's number one. So that's the main thing weighing on perceived or not or non-adjusted gross margin. I will also say that we're definitely, like, in this climate, there are certain things. There's rising beef costs and chicken costs and stuff like that. It's not like we're not seeing other margin impact. However, as you can tell, our overall P&L is growing and improving because our overall costs are going down. And that's a mix of streamlined operations, that's more efficient marketing with lower CPA. Also behind the scenes, a little bit more nuance for your audience, but like, we've been successful at raising prices this year at True Local, starting spring. And the beauty of having a real brand and real community and like a purpose-driven and mission-driven company is when we raise prices with True Local, instead of getting angry messages or frustration, we're getting thank yous. Thank you for supporting local. Thank you for investing in the local ecosystem. And that's huge, right? Because we have an authentic brand with an audience that really appreciates the mission. And so we don't see it more churn as a result of raising prices. So we're actually acting more SaaS-like in a way, or more recurring in a way, although we're not officially a recurring model, but we are a subscription model there. But we do have pricing power, which is something very few consumer companies can say.
Excellent. So I was going to actually, great segue. I was going to ask you a bit about the businesses. Are these like one-time sale type businesses? Is there any sort of sticky kind of reoccurring kind of revenue opportunity? Sounds like you mentioned there's some subscription based sort of revenue, so it's a little bit more predictable rather than just trying to win back that customer, slot in for automatic sort of repeat orders.
Right.
How does that sort of break down between? Is it 4 brands that you own right now?
Yeah, so we own exactly. We own 4 brands. True Local on the one end and the 3 golf brands. So 4 total. I would say this. First of all, True Local is almost 100% subscription, membership based, reoccurring revenue. These are memberships of an average order value of $237 a month, where folks are spending that amount to get their proteins, their chicken, their beef, their seafood, straight to their door like clockwork. And so, we have folks on the platform that have done 15 boxes, 20 boxes, 30 boxes, and all the way through. There's more than that too. I think we had this anomaly of someone doing 100 boxes. Turned out he owned a gym and he was buying it for his all his people and members and so forth. So big picture, like, True Local is extremely sticky. We have some of the best CLTV to CAC, i.e., customer lifetime values, almost $2,000 relative to a customer acquisition cost of $124. By the way, that 124 is down from 175, and in part because of the Buy Canadian and Support Local movement and environment that we're seeing. So CAC has come down, CLTV has gone up, and those are the 2 big words in e-commerce. Mm-hmm. What do we do to grow CLTV? What do we do to reduce our customer acquisition cost? And so with True Local, it really does act that way. So it's everything from brand to the actual model. Okay, a lot of, like, when you think of food subscription as meal kits, they're high churn. People quit on them within 2 or 3 tries. Not the case with True Local. This is a 90% plus recurring member base on any given month. Our revenues are coming from 90+%, same audience. Okay.
What market does True Local service?
Canada. We are a Canadian. We're number 1 in Canada, and we are Canada only. And we only work with local farmers here. So I think the equivalent here are the big gorilla in this space is ButcherBox in the US. They're a $500 million revenue business. We know them well, and we are the quote unquote ButcherBox of Canada. And we're, in Canada, we should be much bigger, frankly, than we are by being number one. We're only a $15 million company, so that's about 55-60% of our revenue. The next largest player is half our size, but we think this is an early market. I mean, grocery is notorious for coming late into the scene for e-commerce, but the pandemic has shifted that. Now, obviously, we've come down from the pandemic, but now we're all the way back up. We've been growing 2 straight years in a row. We've been managing the business with discipline. We've doubled profitability this year. This year alone, we've doubled profitability for the True Local business. And we're doing it efficiently and with a great macro. I know people have a tough time in this macro, but we're very fortunate to be at the forefront of the face of Canadian local tech.
Well, thank you. That's a very good overview. You answered a couple of other questions that I was going to have for you on that. So fantastic. Based upon the skill set that you have a bit of, you got some banking experience and stuff like that. Are you like an M&A guy at heart? You love like chasing the next deal, or do you love operating what you have? Like, what's your skill set as a leader?
Yeah, I'm smiling because obviously, like, I love deals and deal making, but
Yeah,
I really don't view myself as just a deal maker. And I didn't say this earlier, but when we had to clean Emerge up and sort of sell some businesses, and also don't forget, we had all these middle management folks, founders that we had, whose businesses we'd acquired, and initially were sort of letting them run these businesses through some tough times. And we only found real success when we rolled our sleeves up and injected ourselves into these portfolio companies to fix them, to grow them, to turn them into cash machines like they are now. And I love that part of the business. I am personally running True Local. We have a great COO on the golf side. His name is Morris Finn. He's working his magic on that side of it. But I am very much a brand guy, a story guy. And in this case, we came in and we right-sized this business. We improved its margins. We got the marketing piece right. So I'm pretty hands-on there. And and it's almost like sometimes it's not the first time I may have heard like, okay, well, maybe I'm the deal guy and people are running around, and there are people running around. So credit to our team. I couldn't do it without them, but I'm certainly very, very hands-on what's going on right now and sort of where we are with this turnaround that's only really happened, frankly, once the Emerge HQ team jumped in.
and you've kind of turned a big corner. Like, I think peak debt level, you had over $30 million sort of worth of debt. You've been able to scrub off about 80% or so of that, like you said at the beginning of our chat. Do you have any further kind of deleveraging that you'd like to sort of do?
Yeah, I think so. In the context of the debt, we really now think of it in terms of debt relative to EBITDA,
Sure.
right? And once
Yep.
upon a time, we had no EBITDA, so debt was effectively infinite. Not only was it 30 million, we also had no EBITDA at some point as the thing was coming down. But we find ourselves in this much better position where our net debt, which is essentially our senior plus our convert plus some deferreds minus our cash, is about 4 million or so, give or take. And our EBITDA, let's say year to date, was 1.25 million. So you can extrapolate, if Q4 is relatively around the Q3 levels, whether it's 1.5 million or 1 point, whatever it may be.
Yeah.
Those that sort of net debt to EBITDA level is way more reasonable. And so for us, we're not rushing to pay down more debt or sell. We're definitely not selling businesses right now, right?
Sure.
Like we're done with that.
Yeah.
And we are sitting on some excess cash, and we are thinking through the trade-off of using cash to pay down debt versus using cash to buy the next tee to green. Both have advantages, but ultimately what we're also doing in parallel is looking at what's available to us via bank debt and others, because the debt we've sat on since 2019 with our same lender. And by the way, through it all, we've never missed an interest payment. We've never breached a covenant. We stuck with it. And it used that facility used to be 25 million. It's now 5.85 million. But we're probably more inclined to go offensive. We're not here to play defense anymore. We're past that, which means if we can go acquire another, million EBITDA company or thereabouts, right, and do it at a very reasonable multiple, right, relative to where we're trading and just overall from a overall serviceability perspective, then we can elevate our EBITDA relative to our debt. And that's a winning formula because we expect significant interest rate savings given our new cash flow profile, right? So right now, Emerge is paying about 11% on our senior debt. It's a variable rate. So as interest rates come down, it's been coming down. The peak was like 13.75%.
Wow.
And now we're in the 11 zone. And so we think cheaper debt means something substantial. I'm not here to switch out a facility for a half a point or a point. We're
Sure.
talking, could we go 4 or 5, maybe 6 points? That becomes super exciting and adds hundreds of thousands of dollars in cash flow immediately in that year, kind of thing, right?
So, are you thinking if are there any other segments that you want to get into, or are you like pretty locked in on grocery and golf? Or if there's a good business with a good EBITDA that does have that relates to the skill set of your team, is that something that you would hop all over, or are you really regimented in terms of these sort of two sectors?
Yeah, well, we're not going into HVAC or plumbing or landscaping anytime soon. I don't think you're going to see that out of Emerge Commerce. I will say that as our management presentation, which we recently updated for Q3, and as we've been saying there and on earnings calls and meetings, I think the big picture for us is that we got grocery and golf, $200 million TAM opportunities in Canada, both organically and through acquisitions of competitors and adjacent areas, etc. And I think the other pillar that we look at and consider very seriously is what we would define as e-commerce enablement, and really sort of what we can do to supercharge both of these up, right? So it's essentially that we look at that as more as a B2B, a software world where we want cash flow. And if you think of our model, like anything that'll reduce seasonality, anything that'll reduce inventory, anything that'll give us more cash flow, but at the same time supercharge the two big words in e-commerce, CLTV and CAC, one or the other or both, we're going to consider that, right? So we're now thinking strategic acquisitions only. The era of diversified for the sake of building out the empire is long gone. And where the interest lies now is how do we supercharge our portfolio? With Tea to Green, it was a boring offline cash flow business. But look, not only did we add cash flow, but we added leverage from our audience to Tea to Green to grow it instead of 3%, 30+%. So we would consider digital / e-commerce B2B applications that could strengthen and give us really an unfair advantage in customer acquisition.
Very interesting. How big's your headcount now, full time staff?
Yeah, so we're in and around 27 employees full time, which is about $1 million revenue per employee. So we think that's on the high end of best in class, or at least in best of class. Encourage investors to definitely check us and compare us to other e-com and other digital brands and businesses. But we think that's highly efficient. Now that excludes warehouse folks and contractors and etc. But I think $1 million per employee is certainly something we're proud of, and it took a lot of work to get here.
Are those like hybrid? Do they come into an office? They work remote? How much FaceTime are you getting with your 27 staff?
I never stopped coming to the office ever. Like even during the pandemic, I just enjoyed doing that. We have a really tight HQ team. We've streamlined it. As you know, we don't need everyone, all the top folks running around babysitting all the other brands. And I think HQ has a hybrid approach with our office here in Toronto. True Local is fully remote. Obviously, warehouse folks are full time at the warehouse across the country, and same for T to Green warehouse folks. And then both Underpar and T to Green are pretty much remote, but with some hybrid. Some will pass by and swing by. Most of those businesses are in Ontario, by the way. And then some of the West Coast folks are also remote and swing by, more like on a quarterly or semi-annual basis.
You get some economies of scale where you can have some of the same staff work on multiple brands. Like, for
Yep.
example, the e-commerce aspect of it, you're able to sort of, again, if you've got really good expertise and you guys know how to drive cost of customer acquisition down, is that something they're able to translate onto some of your other brands?
Yeah, and we already certainly are. So examples are, so from HQ perspective, our head of data and analytics, our marketing team. It's a tight team, but they work on a bunch of different brands. So whoever worked on T2 Green also works on Underpar and Just Golf stuff. There's some customer service sharing. There's some IT sharing. So these are all real and already recognized. To give you an idea, though, like we've really streamlined HQ, which used to be north of 3 million in cost at the back then in the peak. Sort of almost approaching 1/3 that level. To be between 2 and 3 times, between 1 and 1.5 million, essentially is what that looks like. But at the same time, we have about 3 million plus in brand level EBITDA between all the different brands. And so we definitely do some sharing, but we have a much tighter team overall.
So are you having more fun? You personally, are you having more fun now than you were maybe 2-3 years ago?
Well, listen, when you're in the basement and you're in the dark, that's anything is fun after that. And I think that we coming out of the storm and surviving it and gaining the respect and the support of many. That's been like obviously a very gratifying, very rewarding, very motivating. We're making people money again, right? Anyone who believed in us in our darkest hour essentially is up 10x, and we haven't even started. Like the climb is still coming up. If we execute, if we grow, if we continue to do discipline deals and keep things structured and careful and brick by brick keep moving, that's super exciting stuff for us. But yeah, like I'm highly energized. I know we still have a long way to climb, a really long way to climb. But when things are starting to work and you look back a year ago, 2 years ago, even 3 years ago, we are on a consistent progression up on the way back up. And I think that attitude and that mindset and sticking with it and bringing in more long-term people around us, everything's been cleaned up. All of our warrants are pretty much gone, as you might have seen from our press release. By the end of this year, warrants will be cleared out. Interest rates are finally coming down. Golf is gaining in a discount world, in a recession world. True Local is getting from the local side of things. So I have more reasons to smile, and certainly we're really busy at work wanting to prove this next phase even better.
So that's a good segue. I was going to ask you, let's get into cap table. Approximately how many shares are outstanding?
Yeah, about 150 million shares outstanding right now.
And what's insider ownership look like?
So between myself, board, management folks, we're approaching 20% with full securities. I am still, to my knowledge, the largest individual shareholder in Emerge. I have not sold a single share to date since going public in 2020. I've only acquired shares. You can look all of that up.
Yeah.
And I've been acquiring, including in this year. And as you might have heard, I've exercised my out of the money options as well in support of our warrant holders who exercise their out of the money warrants at 10 cents, and I did mine at 11 cents. So we're putting our money where our mouth is. And by the way, just to be clear, no one else on the board has sold a single share since being public right now.
And you just mentioned you had about 24.5 million warrants that have expired between July and last month, November. So you should be able to enter the 2026 here. Like right now, you're essentially warrantless. You don't have any warrants, or will have very negligible sort of warrants outstanding. So that gives you a much cleaner sort of cap structure. What about the question of future dilution? You haven't done a placement in a while. You're trading on the venture exchange. It's a pretty common thing, and you've had your stock go from a penny to 10 cents. Ooh, are you got an itchy trigger finger? Should we, think that maybe there'd be a sort of a financing coming to, is that something that we should pay attention to, or you can't really say?
No, I just don't see why we would raise capital for the sake of it. It has to be something strategic down the line. I think we have the cash that we need now, where our cash position continues to grow. Partly, if you think of it, not only is it the operations, it's also this T to green advantage that we've created for ourselves, right? With the cash flow and the owning this inventory and paying it over 8 years, it's effectively, generating all this excess cash here in the early years. So we're really feeling good with where we are, and I think the bigger question for us is what to do with some of this cash and whether we want to pay down some debt, whether we want to do the next T to green. Overall, I think we're feeling really good. We're not. We believe, and I should say, I believe the new momentum in the business, in the profile, in the macro for us at least. All of this is going to mean better things for us down the line. And I think we just want to be super careful, super strategic with what we do, super intentional. My real focus here now is more like, what is that next acquisition? Maybe we have one lined up, maybe we have two lined up. We can't say with certainty, or we can't disclose, but
Sure.
we're really zoning in and thinking like, what did we just do with T to green? Our cash position, if you think of it, is way better than it was when we did T to green a few months ago. Sorry, rather
Yeah.
in
Yeah,
April.
in April. Yeah.
Right. So I mean, you can look at where we ended Q1 with cash and how we did that. We didn't raise capital to do that deal. But we're always going to be careful and thoughtful about what does it look like. We also want to understand, what do these proposals from the banks look like? What is the interest rate savings? What are the bells and whistles? Can we live with them? And then compare that, and also be like, well, what are we doing on the acquisition side? What's possible with our cash? Think through it. In the end, it's very simple formula. We want to grow cash flow. We want to improve debt to EBITDA, and we want to strengthen our inherent model. Whether it's reduce seasonality, do other things strategically that allow us to grow and blossom through good times and bad. And we're setting ourselves up for success.
Do you have a pipeline of potential opportunities? Are you getting approached quite a bit? Do you have a team
Oh
or
yeah.
somebody that's responsible for trying to track down
Oh yeah.
new M&A opportunities?
Yeah, no, we have sort of strategic or financial advisors, consultants, whatever you want to call it, for some of this stuff. I am heavily involved in M&A by virtue of being on the deal side for so long. And by the way, I orchestrated the sort of the T to Green transaction once my head of golf brought it to me, sort of dealt with
Yeah.
it. So we're definitely active. I don't want to make it sound like we're just hanging around. We want to make sure the next deal, which hopefully is sooner rather than later, we want to make sure that it does exactly what it's intended. If it can do another T to green lift, that's beautiful. But we want precision here. We're buying cash flow. Be super clear. You're not going to see us buy something loss making. You're not going to see us take on more debt, right? So, but we're really focused on saying, okay, with the cash, it's a better cash position than we were with T to green. How do we now think through what is that next move to do it? And so, to answer your question, yeah, we definitely have a couple of serious opportunities. We are advancing them. We're not going to do like a million deals either. We're going to do one deal at a time. Last deal was April. It's going well. Last I checked. Getting ready for the next one, right? We're getting ready for the next one.
Yeah, great. Well, you do seem like a bit of a deal maker. You'd probably be bored if you just had to manage what you've got. So I do hope that you guys are seeing some good things, and you'll get a chance to roll up your sleeves and do what you do best, which is a transaction. So M&A, it all sounds really good, and you've obviously seen the good, you've seen the bad, you've had to deal with it, you've had to weather the storm, and you've got a pretty healthy looking business here today. Everybody always underestimates integration. once you get somebody to agree to a
Yeah.
deal, what's your sort of, you've had to go through some hard times, some good times. Do you have any sort of comments about integration? Is it harder than it seems? Do you have a pretty good handle on it now after all the deals that you've done?
Yeah, I would say that you know we don't like any crazy risk doing these deals. So I'd be lying to you. I could make it sound fancier than it is with T2 Green, for example. The essence of it is T2 Green operates its business the way it has for decades. We've come in and introduced eyeballs to that business. We're not mixing and matching and going crazy on, anything. They have offline stores, they have a warehouse, they have things we didn't. They have licenses that we didn't have access to. So we're not coming in and doing this fancy tech integration that has huge risk. And that's my style of M&A right now in this phase. Down the line, as we have more resources, more tech folks, we can be more audacious. I don't want to be audacious right now. I just came out of a 2-year turnaround. I want to be certain. I want to be, precise, right? And so we want to be mechanical with what we're buying. We're not looking for fancy integrations and migrations, and because that's where a lot of this stuff breaks, especially when you're on a streamlined, bootstrap
Yeah.
sort of way of things. But I will say that over time, we keep unlocking more. So if you look at as what I mentioned with Just Golf stuff, when we acquired it, it was on like a weak little site. We moved it to Shopify. We merchandised it the right way. We applied our ad tech to it, and we've grown it 10x since. So it's incremental is the way we view it. The insane lift that we saw with T2 Green was a bit of a function of them never having advertised online properly in their lives. So we come along and we're just like, boom. Imagine like, all of these stores never really tapped into Facebook or Google and so we come in and it's like night and day for us. It's very obvious what we can drive. And so we want that ARB. We want to buy stuff with ARB, right? With arbitrage.
Yeah.
And we want to buy it at great multiples because the seller may not see what we see in it, right? And may
Mhm.
not have the strategic tie-in that we do, right? So,
Right.
if we go buy an e-commerce enablement company, we're not only we'd love that it would have cash flow and it won't have inventory and it won't have seasonality. That's all great, but it's also even more interesting if we can use that technology to reduce our customer acquisition cost, for example, right? And
Right.
so that's the level of strategic thinking that we're bringing to the table.
Fantastic. Let's talk valuation. What do you think a company like yours should trade at on sort of like a revenue and EBITDA multiple?
Well, normally I'm normally advised to say that's your job, and leave it at that. And the one thought I'll leave and share because it's been thrown at me a lot in recent weeks is there are businesses and brands, and there's no shortage of examples where consumer e-commerce brands or omni-channel brands, like there's many out there, especially in the US. There's fewer pubcos in Canada you can point towards, and I really like. So I hear it often. Like there's a few names I keep hearing often as maybe general landscape type names that can help us, extrapolate. And I'll leave the extrapolation to the investor side. But there was an interesting transaction in the market with TrueBar, which a lot of people draw a correlation to Emerge in the sense that it was a holdco of many things, decided to focus. It got strength with it with that brand, that one brand, the CPG. It's
Yeah.
not just online; it's also in retail. And it got I think whatever it was 2 or 2.5 times EBITDA rather revenue multiple. Sorry, let's be clear.
Revenue. Yeah. I don't think he even had an EBITDA.
Right, and
Yeah.
it's fun to look at some of these things. There's other examples of e-commerce meets omni-channel, like we're doing now with T2 Green. For example, Build Direct trades extremely generously, or maybe in their minds reasonably to their EBITDA and revenue. There's and then more at scale. If you look at Kits, eye care, that's a much bigger, couple of 100 million trading at 2-3 times revenue. Maybe it's come down a bit. And so when we look at all of that and say, well, Emerge trades at about a half times revenue, maybe up a bit now, it's 0.6, maybe 0.7. given some of the share price appreciation in recent weeks and months. Um, so that's the revenue side. And you look at it on the EBITDA side, some of these don't really have crazy amounts of EBITDA, and they have very minimal margins. So it's hard to really compare. But I think we're on the right track, and I think we're, from a pure valuation perspective, I'm not going to sit here and tell you we're worth X or Y. I am going to say that as a student of e-commerce and D2C and CPG for the past 15 years, I can tell you the ones that scale, that do it well, end up getting 2 to 3 times revenue. I think some of the good ones that maybe don't have profitability might be a 1 times revenue type business. That's very common. Like if you're growing but not profitable, but we're growing and we're profitable and we're cash flowing, and so we feel good about where we are, and I know the stocks come a long way in the last few years. We're probably one of the fastest growing stocks in Canada from where we came. I know that's not saying much, but more important is not that the turnaround has been completed. We're feeling good. We're going on the offensive, and we'll let the market do its thing as we keep executing.
I thought you put out a great tweet the other day. I've never grinded so hard for 10 cents.
For a dime. It's true.
Or worked so hard
That's
for
true,
10
man.
cents. But
Where do you think all these gray hairs come from?
and I think you're still married, so I guess you handle the stress well.
Yeah, well, my wife, credit to my wife on that one for sure.
That's great. So, what would be some? Let's wrap up here. I know you got to get on with some other things. What's a couple what there's some catalysts that we should be paying attention for?
Yeah.
Not necessarily specific things, but like some general kind of catalysts. Like,
No, we're very consistent about that stuff. I mean, we don't like to throw 10 things at the wall. It's a very specific roadmap. The catalysts are threefold. One, continued operational execution year over year, right? We talked about that from top line to bottom line and cash flow, everything in between, and continued improvement on the balance sheet, which we continue to clean up, continue to improve our overall position. And then two is, frankly, the next accretive acquisition. Super clear. We're sitting in a more strategic, more offensive position right now, the way we view it. And we want to be very intentional about our next move. And that next move has to improve cash flow, has to improve our debt to EBITDA, has to improve our overall strength of the model, as we talked about. So that's very clear. And part three, and whether 2 and 3 are related, correlated or not, or happen together, or one after the other, etc., hard to say. But the third piece has to be a longer-term, cheaper debt facility, as we talked about. Whether that's 3, 4, 6% interest savings, TBD, but something that's commensurate with our level of maturity in the cycle, our level of profitability and cash flow. I think all of that ties in really well. And I really think if we do all three, if we continue to grow the way we're growing and do so with discipline and apply a next acquisition and apply a cheaper, longer term facility with 4 to 6% cheaper, I really think sky's the limit in terms of where we're going to be, 6 months to a year from now.
any final thoughts you want to leave us with, or was that about sums it up?
Well, my final thought is I've really enjoyed. I saw you put out an article on us. It was balanced and reasonable, as I told you offline. Once in a while, someone says something nice about me, which I appreciate, because it's really been, my personal mission to stick with it, to clean things up, to bring it back, and now to win. I'm not here to just bring it back and hang around these, above survival levels. We are here to get excited and get everyone around us that's aligned with us, that's supported us, that's loyal to us. We really want to make this a great outcome. We control what we can, but now, everyone knows now that we don't go out without a fight, and we're not planning to go out. We're planning to grow up, and that's the bottom line.
Well, Ghassan, it's been really nice to catch up with you again. I'm glad that you didn't move on to like something else. You stuck with it and you've grinded, and now you're starting to reap some of the benefit of all that hard work. So I'm glad that you sort of stuck it out, and yeah, you've provided phenomenal return for some of those shareholders that were lucky enough to buy at a penny or 2 cents a share when it was some tough times. But I still think that there's quite a bit in terms of valuation from, my own personal sort of opinion, trading at less than 1 time sales, and profitable business. It's pointed in the right direction again, and I like what you say in terms of being like, you've got a model. You're going to stick to the model. You're not just going to do anything to throw numbers at the wall
Right.
and all that. So look, I look forward to sort of staying in contact here. The way I like to try to do it is stay up to date, sort of on kind of a quarterly kind of basis. When you've got some next major
Right.
sort of like milestones or financials out. So I really appreciate the time, and
Thank you.
wish you a great year end here.
Thank you so much. Happy holidays if we don't speak before then. I appreciate you covering us and sharing the Emerge story with your audience.
Thank you so much.